I want to bring in Kevin Nicholson, Global Fixed Income Co-CIO at RiverFront Investment Group. Kevin, certainly some disappointing numbers here.
When you look at the 4-week average just coming into this, on the initial jobless claims, the 4-week average was 759,000, and continuing claims were somewhere around 4.3 million. While they have been trending down lately, this number is disappointing to markets. We've been saying for some time that there was going to be basically a job-like recovery, and we're kind of seeing this as we haven't, as Baker mentioned, we still haven't reached the lows that we saw in November on initial jobless claims. And so I think that this is going to continue to be a slow grind when we think about employment. We still have 9.5 million jobs that haven't come back online from that 22.5 million that we lost earlier last year.
It is striking to me because, of course, it comes at a time when the market is on fire, right? The Dow at record highs, the S&P at record highs, the NASDAQ near record highs. Does this just even add more credence to the fact that this is very much a K-shaped recovery?
Oh, definitely. We're definitely seeing the haves and have-nots. And unfortunately, those workers that are have been displaced, they're going to have a harder time. And I think part of the reason that we haven't seen a lot of those 9.5 million jobs come back online is because we have a skills mismatch, and we're going to have to retrain our workforce in order to get a lot of those jobs back.
When you talk about the Dow, above 33,000, what is driving the markets at this point? And do you think at any point, the economy, just with all of these people unemployed, does that ever catch up to the markets? I don't know. It's just, again, the disconnect here, really incredible.
Yeah, I mean, we have said for a while that, it's a difference between what drives the economy and what drives markets. And, markets are forward looking. The economy is more, rear looking, or the here and now. And what we're seeing in the markets is that you're constantly seeing earnings revisions, especially on the S&P. Right now, you're talking $172 of operating earnings are predicted for this year. And so that has been a constant driver of the stock market going up, and it's been helped by the fact that we've had low interest rates. There has been no other alternative until recently. I mean, up until now, with the 10-year around 173 this morning, it has significantly surpassed the dividend yield that you have on the S&P, which is right around a 1.46. Up until about a week ago, that was not a real discussion. But now that yields are moving higher, people have a choice to make. However, I still see that stocks are going to do better. When you think about that $172 worth of earnings that the S&P is generating, or is predicted to generate, that earnings yield is right around 440. So it's still significantly higher than where the 10-year is currently.
How concerned are you about inflation? We had Jerome Powell yesterday, as you mentioned, basically saying interest rates are going to stay low till 2023, the earliest. Is this the right move, given that the market's on fire, that the economy does appear to be coming back? Or do you think Powell's looking at jobs numbers like this and kind of thinking about the 10 million Americans who are currently unemployed?
It's definitely the latter, that the Fed chairman is looking at the unemployment rate. They're trying to get back to full employment in the U.S., and so they're willing to let inflation run hot, so to speak. However, I'm not worried about inflation for a multitude of reasons. Because we're not seeing a rise in wages, we're not seeing that wage pressure, so that isn't going to cause increased demand, or because you would normally have more discretionary income. But more importantly, I also believe that technology and innovation naturally puts a cap on inflation because it's deflationary in general. And so while we will see some industries raise prices and you will see some inflation there, you're going to see some industries that are going to have to lower prices. And so I think net, you're going to kind of be the status quo. And so that's kind of why we think that inflation is not a 2021 issue. It is more along the lines of 22 and 23. They're years out before inflation becomes a problem. And a lot of it depends on how fast interest rates move higher and the growth prospects that we have.
What are you thinking in terms of employment? When do you think we might start to see a real difference? I wouldn't even say full employment, because I think that that's probably still a couple years off, but when might we really see hiring pick up?
Well, I think you'll see hiring pick up once we reopen the economy fully. I mean, there are a lot of service jobs that are on the sideline right now, as a lot of states haven't reopened their restaurants, and then when they have, they've been at 25 to 50% capacity. So I think that once you get a reopening, a lot of those restaurant jobs will come back online. You will also see a lot of the travel and services come back online, and so that's going to help the jobs numbers.